Let me review this topic. Before we do the past paper question. What we want to find out now is, what is a pension scheme? I am not going to discuss in details. I've said we are reviewing the topic so that we do the question that we are supposed to do. You all know that a pension scheme or a pension fund is an arrangement whereby the employer promises to provide some benefits to the employees when they retire. A pension fund or a pension scheme is an arrangement whereby the employer promises to provide some benefits to the employees when they retire. That's what a pension plan is. The other thing you should know is, how does a pension plan operate? How does it operate? That's what I want to discuss again. How a pension plan operates, how a pension plan operates, how a pension fund operates. You all know this. Listen, you all know this. At the end of the month, the employer and possibly the employee, the employer and possibly the employee, they normally make a regular contribution to a fund. They normally make a regular contribution to a fund. Those contributions are normally invested by the funding agent. They are normally invested by the funding agent. That funding agent could be NSSF, for example. It could be an insurance company if they are managing the pension fund on behalf of a company. There are some insurance companies that manage pension schemes on behalf of other companies. So we are saying the employer and possibly the employee, you make a regular contribution into a pension fund. Those contributions are invested by the funding agent. Then it is that same funding agent who will pay the benefits to the employees when they retire. It is the funding agent who will pay the benefits to the employees when they retire. So in general, this is how a pension scheme operates. In general, that's how a pension scheme operates. We have said contributions are made, regular contributions are made into a pension fund. Those contributions are invested by the funding agent who later pays the benefits to the employees when they retire. Now, my question to you is this. There are two ways that you as an employer, you can go into this arrangement. There are two ways in which you as an employer, you can go into this kind of arrangement. In other words, we have what we call different types of pension plans, So in what ways can you go as an employer, go into this kind of arrangement where you'll be making regular contributions to a fund? Those contributions will be invested and then the benefits will be paid to the employees when they retire. I've said there are two types of pension plans. Somebody name them. In other words, these are kind of arrangements in which you can go into this pension scheme. There are two ways in which you can go into a pension scheme. We call them types of pension plans. So somebody chat and tell me at least one of the pension scheme arrangement that you know. Type chat and please chat. I want to see one type of a pension plan. Good. So somebody has to give us one that defined pension plan. What is the other one? I will correct that in a short while. I'll correct it. Give me the other one. The second one. Give me the other one. At least Nekesa has tried. Give me the other one. Defined benefit plan. Okay, that is what Nani was giving us, defined pension plan. So let me mention them. One of the methods that you as an employer you can use to go into this kind of a plan is what we call a defined contribution plan. We call it a defined contribution plan. That is one method. The second method is what we call a defined benefit plan. A defined benefit plan. So these are two methods that you as an employer you can use to go into this kind of arrangement. Now, let me discuss each of them. It is important that you understand what each of them entails, because some of your past paper questions normally ask you some theory questions for you to explain what is the difference between a defined contribution plan and a defined benefit plan. It's a common thing, especially whenever they are testing you on this topic and on theory part. They tell you to distinguish between a defined contribution plan and a defined benefit plan. Now, let me start. Now, in a defined benefit plan, let me start with the contribution. In a defined contribution plan, the contributions that you as an employer, you make to the contributions that you send to the pension plan, those contributions are normally defined. The contributions that you as an employer, you send to the pension fund, those contributions are normally defined. Defined means they are known in advance. How much you will be contributing to this pension fund, that amount is known in advance. Listen. But how much the employee will take home, how much the employee will take home at the date of retirement as the benefit, that the benefits are not defined. The benefits are not defined, meaning they are not known in advance. They are not known in advance. The benefits, we have said, the contributions are defined. How much you as an employer you'll be sending into this pension scheme or this pension fund, that amount is known in advance. For example, you could have agreed with the funding agent that you'll be contributing 2,000 every month. So as an employer, your obligation is known in advance. But how much the employees will take home at the date of retirement, 10 years from now, 5 years from now, that amount is not known in advance. So the question is this: what will influence the amount that the employees will take home at the date of retirement? You all know, and I've said this, that once you send those contributions into the fund, those contributions are normally invested. So it is obvious, therefore, that if the investments in the fund perform well, then the benefits will be more at the date of retirement. If the investments perform well, then the fund can be able to pay higher benefits to the employees. Otherwise, if the investments perform poorly, then automatically again, the benefits at the date of retirement will be low. So we normally say, though the benefits are not known in advance, the amount of the benefits will depend on the performance of the investments. The amount of the benefit will depend on the performance of the investments. If the investments perform well, then the benefits will be more. If the investments perform poorly, then the fund will pay less benefits. That's important to remember how a defined contribution plan operates. I've said in that defined contributions, the contributions are defined. They are known in advance. But the amount of the benefits is not known in advance. That means it's not defined. Said the benefits, the amount of the benefit will depend on the performance of the investments. Now listen, some students are told to define what's a defined contribution plan, and they just tell the examiner a defined contribution plan is a plan where the contributions are defined, and they stop there. Don't forget, I've talked about that scheme or that plan from both ends in terms of contributions and also in terms of benefits. What happens to contributions? What happens to benefit when I'm discussing the defined contribution plan? So meaning for each of them, you must discuss what happens from both ends. Don't just tell the examiner in a defined contribution plan, the contributions are defined and then you stop there. That's okay. But we are also saying the benefits that the employees will take home at the date of retirement, those benefits are not defined. They are not known in advance. Good. We go to the second one, where we have said the second arrangement in which you as an employer you can use to go into a pension scheme is what we are calling a defined benefit plan. Okay, so let me explain it. We have already said a short while ago that normally contributions are made into a pension fund. Then I have told you those contributions are normally invested by the funding agent. Then I've said it's the funding agent who normally pays the benefits to the employees when they retire. Now, when it comes to a defined benefit plan, listen to this now. In a defined benefit plan, the contributions that you as an employer, you make to the fund, the contributions are not defined. The contributions are not defined, meaning they are not known in advance. Listen, but how much the employees will take home 10 years from now, 20 years from now, that amount of the benefit is defined. Let us assume it's 1 million. So the amount of the benefits is defined. It's known in advance. Let us assume that you as a company, you decide your employees will take home 1 million 10 years from now when they are retiring. So the amount of the benefit is defined. But the contributions that you make into this fund, those contributions are not defined. Now listen, the question is now, because these contributions are not known in advance, how much therefore I should ask myself as an employer, how much therefore should I contribute into this fund so that my fund can create a fund to be able to pay 1 million. In order to meet that obligation to pay 1 million 10 years from now, 5 years from now, how much as an employer should I contribute? How much as an employer should I contribute? Listen, it is at this point in time that you now as a company or as an employer, you will now require the services of the people we normally call the actuaries, or we call them the actuaries, whatever you call them. The actuaries, some people call them actuaries, some call them actuaries, whatever it is. You will require their services. Now, you will tell them, I want to create a fund of 1 million 10 years from now or 5 years from now. Please calculate for me how much as an employer I should be contributing into that fund. In other words, listen, you as an employer and the actuaries, you will sit down and come up with the assumptions of the scheme that you want to design. One of the assumptions is, I want to pay them 1 million. The other items you will have to assume, there are so many assumptions you will have to come up with when you are creating this kind of a fund. So, I've said, you as an employer and the actuaries, you will sit down and come up with the assumptions of the scheme. For example, one other scheme or one other assumption that you will have to agree is, when are the employees are retiring 10 years from now? What are we expecting? What are we projecting to be the market rate of return in the market? You will sit down and project the market rate of return. Let us assume that you project that the return of the investment is 10%. We project that the investments will be earning a market return of 10%. So if we want to create a fund of 1 million and we expect the return on investment will be 10%, So the actuaries will sit down and calculate backwards and see if we are to create a fund of 1 million 10 years from now, and the contributions will be earning a return of 10%. What should be the contributions that will create that fund of 1 million? Listen, they might calculate and say you should contribute 2,000 shillings to the fund. You should contribute 2,000 shillings to the fund, assuming they calculate. I'm just assuming. Now, so they have seen that if you contribute 2,000 and that investment is earning 10%, then it will create a fund of 1 million 5 years from now. The question is, suppose after 2 years, you contributing 2,000, 2,000, 2,000, 2,000, after 2 years, now the return is not 10%, the return is 8%. It means therefore, listen, it means therefore that if as an employer I continue contributing 2,000 and now it's earning 8%, not 10% as per the projection, then it is obvious this fund will not be able to meet the obligation of paying the 1 million. It will not be able to meet that obligation. In other words, this fund will have what we call a deficit. This fund will have what we call a deficit. So the question is, what should we do? Because we can't change the benefits. The employees must still take home 1 million shillings. But our rate of return is no longer 10% as per the projections. Our return is 8%. We agreed with the actuaries that if we contribute 2,000, expecting it to earn 10%, it will give us a fund of 1 million. But now we are earning 8% instead of 10%. So if we continue contributing 2,000, earning 8%, this fund will have insufficient fund. That means it will have a deficit. The question to you is this. Listen to my question. The question is, how do you correct that scenario? Somebody to chat. When you realize that your fund has a deficit, how do we correct that scenario? Somebody to chat and give me the answer. Somebody to chat and give me the answer. We projected that the return on investment would be 10%. We were agreeing that if we contribute 2,000, earning 10%, it will give us a fund of 1 million. 2 years or 3 years down the line, now the return is no longer 10%, but 8%. So the question is, when your fund has a deficit, how do you correct for that deficit? Somebody to chat. How do you correct for that deficit? Because we can't change the benefit. The employees must take 1 million. But if we continue contributing 2,000 at 8%, we can't pay them 1 million. So how do we correct that scenario? Somebody chat. Please chat. Yes. How do we correct that scenario? When a fund has a deficit, what do we do to correct that scenario? Somebody? What do we do to correct that scenario? Yes. I'm waiting for somebody. We are revising MACU, don't forget. We are revising this topic. Not that I'm teaching. Yes. Okay. Yes, can I wait? Or are we gone? Can I wait or are we gone? I want to see how to correct the scenario. How do we correct that scenario? Okay, sawa. Let me continue. Now listen. Now to correct for this scenario, then the employer, listen, the employer will be told to bring in additional, the employer will be told to bring in additional contributions into the fund so as to make up for the expected shortfall. That's why, listen, that's why we said that the contributions are not defined. The contributions are not defined. They may increase or they may reduce. They are not defined. It depends with the circumstance. And so we are now seeing that when a fund has a deficit, to correct for that deficit, then the employer will be required to make additional contributions into the fund so as to make up for the expected shortfall. So as to make up for the expected shortfall. Now listen, what if, on the other hand, we projected that we shall be earning 10%, but now we are no longer earning 10%, we are earning 12%. Listen, initially we agreed with the actuaries that we should be contributing 2,000 to the fund. We projected to earn a return of 10%, and we thought that would be enough to create a fund of 1 million. 2 years, 3 years down the line, after we have started contributing 2,000, a time came when now the return in the market or in the investment was no longer 10 but 12. In other words, it means that if we continue contributing 2,000, now earning 12%, then this fund will be larger than expected. It will be larger than expected. In other words, the fund will have what we call a surplus. So the question again to you is this: how do we correct this scenario when a fund has a surplus? Remember, we can't change the benefit. We can't give them more. We agreed we shall pay them 1 million. But if we continue contributing 2,000, now earning 12%, this fund will be larger than expected. Okay? So how do we correct again that scenario? Somebody now chat. I think you now know. Somebody to chat. What do we do now? When now we realize that if we continue contributing 2,000, earning a return of 12%, this fund will be larger than expected. That means it will have a surplus. How do we correct for that surplus? When a fund has a surplus, how do we correct it? Somebody to chat? Good. At least Zaitana has given me the answer. Good. We stop contributing. Joshua is saying we stop contributing. Good. Sawa. So listen. So what the employer will be required to do, is to stop contributing for a short while. Stop contributing for a short while until we utilize the surplus that was created. Once we utilize the surplus that has been created, then we shall continue. Now listen, that process of stopping to contribute for a short while, that process, we normally call it, or we normally say, listen, we normally say the employer will be allowed to stop contributing for a short while, or in other words, the employer will be allowed to take what we call a contribution holiday. The employer will be told to take what we call a contribution holiday, which somebody has given me. I think it's Zaitan who has told us that we take a contribution holiday. Once we take a contribution holiday, in other words, we stop contributing for a short while, then the fund will continue using the surplus. And once the surplus has been utilized, then we can now continue. Good. So I've talked about the two types of a pension plan. It's important to distinguish the two. And I have said, whenever you are told to distinguish between a defined contribution and a defined benefit plan, please remember, talk about the fund from both ends. What happens to under each plan, what happens to the contribution, and what happens to the benefit. And the other plan also discuss what happens to the plan, contribution, and what happens to the benefits. Okay? I don't have to repeat that. I've already told you. Please don't just tell the examiner a defined contribution plan is a plan where the contributions are defined. You're not telling us what happens to the benefits. You have said the benefits will not be defined. That's what we said here. In a defined contribution plan, the benefits are not defined. We said you may take home more or you may take home less, depending on what? On the performance of the investments in the fund. That was in a defined contribution. If the investments perform well, then you take home more as benefits. If the investments perform poorly, then you take home less. Second one is where we have discussed the defined benefit plan. I don't have to repeat it. Where I've said the contributions are not defined. They are not fixed in advance. We have said the contributions are set. Listen, the contributions are set at such an amount that is expected. The contributions are set at such an amount that is expected to earn enough return to meet the obligation. Okay? Said the contributions are not defined, but the benefits are defined. The benefits are defined. Then I've said the contributions are set at such an amount that is expected to earn enough return to meet the future obligation of paying benefit. Then I've said if it appears or it happens that the fund has insufficient fund, meaning it's a deficit, then the employer will be told to make additional contributions to the fund. Otherwise, if the fund appears to be larger than expected, whereby the fund has a surplus, then I've told you the employer will be told to take a contribution holiday, meaning let him stop contributing for a short while. Good. Now, what we want to do now, so that we go to the question now, we want to look at what are the financial statements, listen, of this funding agent. We have just been saying contributions are made to a funding agent. So which financial statements or final accounts does this funding agent keep? Whenever he's receiving contribution, whenever he's investing, and so on, what are the final accounts of a funding agent? Those are the accounts I want to talk about, just to remind you, then we do some questions, okay? Now, so we are looking at now the financial statements. One of the financial statements of a funding agent is what we call a statement. Don't write. We normally call it a statement of changes in net assets. So a funding agent has to maintain one financial statement we call a statement of changes in net assets. The second one is he has to maintain another or prepare another statement we call statement of net assets. Those are the two financial statements that a funding agent will be required to prepare at the end of the financial year. Now, a statement of changes in net assets is the equivalent. It's the equivalent of the profit or loss of a business. A statement of changes in net assets is the equivalent of the profit or loss. It's only that we don't use it to determine the profit for the business. No. Instead, what we as a business would call the profit, these funding agents will call it either a surplus or a deficit. Just like if you remember, when you did financial accounting, you did a topic called non-profit making organizations. Then they were preparing what we call income and expenditure account. Okay? Whereby they had to determine their profit, but they don't call it profit. Again, they were calling it surplus or deficit. Okay? So in summary, therefore, I could just say that a statement of changes in net assets is a statement which is used to determine either a surplus or a deficit of the fund. Good. Now, a statement of net assets, the second one, a statement of net assets, the second one, is just a normal balance sheet. Okay? It's just the normal balance sheet or the equivalent of a balance sheet of a normal business. Except in a business, you have what we call capital. In a business, you have what we call capital. And when you are preparing a balance sheet of a business, we normally say capital, add net profit. But when it comes to funding agents, or when it comes to a fund, they don't have what we call capital. In their case, that capital, we normally refer to it as an accumulated fund. So their capital, we call it accumulated fund. So in their balance sheet, which is the statement of changes in statement of net assets, we normally say accumulated fund. Then you add either the surplus that you got in your statement of net assets, changes in net assets, or if you had a deficit, you minus. But in a business, we normally take capital, add net profit. Otherwise, listen, otherwise, the rest of the balance sheet is the same way you prepare this statement of net assets. So with that idea now, let me take you through the questions that I wanted us to do just to remind ourselves this topic. It's a topic where you can get good marks. It's a topic where you can get good marks. Now listen. To prepare a statement of net assets, no, changes in net assets, listen. To prepare a statement of changes in net assets, you just take or find out from the question, what are the revenues or the incomes of that funding agent? What are the revenues? Now, it is obvious. Listen, the most common, I'm just going through in an overview, the most common or the most obvious revenue for a funding agent are the contributions. That's the main source of revenue. These contributions could either be from employers, whatever they contribute on your behalf. Don't forget, in a pension scheme, I said the employer and possibly the employees. The employer and possibly the employees. In some pension schemes, you as an employee, you contribute part of your salary for pension, and the employer also contributes part of that for you. Okay? So we are saying how much was the employer's contribution, how much also was the employee's contribution. Now, still under contributions, listen, still under contributions, there are some employees who may say they want to go home with more than what the company wants to give them at the date of retirement. So they say, or they tell the employers, instead of deducting 1,000 shillings or 2,000 every month, please deduct from me 5,000. That extra that you as an employee, you are making as contribution, we normally refer to it as voluntary contribution. Voluntary contribution. If the law requires we deduct 2% of your salary or 1% of your salary as your contribution, then you decide you want to deduct 5%. That extra 4% contribution you are making is what we call a voluntary contribution. Good. That's one of the major sources of revenue for this funding agent. The second main source of revenue is the investment income. Don't forget, I have just told you a short while ago that these funding agents would normally invest the contributions. Either they will invest in buying property and therefore they will be earning rental incomes, or they will invest in buying shares, they will receive dividends, or they will buy treasury bonds, they will receive what we call interest income. So whichever source of revenue, whichever source of investment income they are getting, which could be what I've said, is dividends received, it could be interest income, and any other form of revenue, any form of investment income, whether it's rental income and so on. That's another source of revenue for them. Good. Now, another source of revenue for this funding agent, if I may remind you, listen, for example, you as an employee, you are operating in, or your contributions are being sent to a funding agent A. Let's call him A. Every month, your employer normally sends your contributions to a funding agent A. Then after some time, you got another job, and in that other company, they normally make their contributions to a funding agent B. So you tell your previous funding agent or your previous employer, please transfer my contributions, or my fund transfer my contributions to this funding agent B. So B will be receiving some transfers from other schemes. We have scheme A, which was operating where you were before as an employee, then you transferred and now went to another company which operates under funding agent B. So you don't want to withdraw your money from funding agent A, but you want the funding agent A to transfer the contributions to funding agent B. So you as a funding agent, it is also possible that you may receive transfers. We call it transfers in from other schemes. Transfers in from other. This is transfers in from other schemes. So let's assume you are funding agent B. You are receiving from funding agent A. Good. So that's what we are saying. Listen. So you will also go through the question and look for other sources of revenue. I've only given a few. Whatever the sources of revenue, you will identify them from the question. Then you now list the expenditure. Less the expenditure. How much was the outflow from the fund? How much was the outflow from the fund? For example, one of the most common expenditure is when you pay pension, or what we can call benefits paid. At the end of the year, there are some employees who retired and you have to pay them benefits, okay, or pension, whatever it is. Good. Another one could be the normal admin expenses of the fund. Rent, maybe electricity, water, insurance of the fund, whatever it is. Good. We are saying normal admin expenses. The other one could be, again, now that you are a funding agent B, listen down here, as I told you, you are a funding agent B. You could also have been instructed to transfer funds from you to a funding agent A. So if you are funding agent B preparing your final accounts, then you may also have what we call transfers to or transfers out to other schemes. Transfers out to other schemes, whatever it is. So again, through the question, you'll be able to tell this is an revenue, this is an expenditure. This is a revenue, this is an expenditure. So you identify all the expenditures again, whatever it is, get the totals, then you minus, then from the revenues, you minus the expenditure, and you remain with either what we are calling surplus. If it's a positive, or if it's a negative, you call it a deficit. You call it a deficit. So this is in general, how you prepare a statement of changes in net assets. How you prepare a statement of changes in net assets. Now, of course, I've told you the other statement was the statement of net assets, which is the normal balance sheet. I don't have to go through the format. No, that is a normal balance sheet. The only difference I've told you, in their balance sheet, they don't have capital. They have what we call accumulated fund. That's what I've told you. Then you add the surplus or you minus the deficit. Good. So let me project the question that I want us to do. It's a common question in your exams, looking like a common question nowadays, looking like a common topic, fund accounting, of how to account for pension schemes, where we are saying again you can get good marks. Let me project the question that I wanted us to do. Good. There are two questions I wanted us to do. I've projected the first one. And that question is a question that came in the April 2025. The question that came in April 2025. That's what I want us to do. It was question number 4. April 2025. It was question number 4C. I want to read it. April 2025, question 4C. It says, Elite Limited operates a pension scheme for its employees. by the name Smart Retirement Benefit Scheme. The following trial balance was extracted from the books of the scheme as the 31st December 2024. You are given that trial balance, normal contributions by 1, the employer, that's what we are told. Next, the employees. Then you have given transfers in from other schemes. Number 3, next item, individual transfers out to other schemes. Next, investment income. Next, property, plant and equipment. Next, government securities, those are investments. Next, members voluntary contribution, I mentioned it. Members voluntary contribution, I mentioned it. Next is pension. How much did we pay for pension this year? Next is equity investment, those investments which are quoted and those which are unquoted investment. Next, you have unpaid benefits, meaning you owe some employees some benefits by the end of the year. I can see it on the credit column, 320. Then you have accumulated fund on 1st of January 2024. Then you have accrued expenses. Then you have administration expenses. You have cash and demand deposits. Then you have change in market value of investment. Change in market value of investment. I can see the amount was 22,640. Now listen. This change in the market value of the investment, I want to ask you a question. The examiner is not telling us whether the change is a gain on revaluation of the investments or it's a loss on revaluation. So look at that trial balance and tell me, do you think that the change in the market value of the investment is a gain or loss? I want to see. We have been given in that trial balance, the third last item, change in the market value of investment. The amount is 22,640. What my concern is, they are not telling us as a student whether the amount is a gain on revaluation of the investment or it's a loss on revaluation. So I wanted us to see or to tell me whether you think it's a gain or loss. Good. Good, correct. It's a loss on revaluation. Listen, losses are always a debit balance. Gains are always a credit balance. You can see, and you already know, if it's a loss, then they must have credited the investment. If it's a loss, it must have credited. Investment is an asset. Reduce the value of the investment, you have to credit the asset, and of course you debit the other corresponding account. So this being a debit, then automatically it reflects the loss. Okay? Otherwise, if it was on the credit, then it will reflect a gain, meaning you must have debited investment, you must have credited the other corresponding account. Good. That one we are treating it as a loss, we are treating it as a loss. Next. After that, we have withdrawal from the scheme. No, not that, sorry, not that. Reading another question. Okay, fine, sorry. Okay. So now after that, we go to retirement, lump sum benefits, lump sum retirement benefits. Those are what we paid as lump sum. Then contributions due in 30 days. There are some members who have not paid as contributions. We are demanding from them. That's a data. It's like a data to us. Then you are required. Number 1, a statement of changes in net assets for Smart Retirement Benefit Scheme for the year ended 31st of December, 2024. You can see there you have 5 good marks for free. Number 2, Smart Retirement Benefit Scheme statement of net assets as at 31st of December 2024. Again, another 5 marks. So let's prepare what we can call an income statement. Good. Which we are saying it's called statement of net assets. No changes in net assets. So let's do that question now. Let's do that question now. So let's prepare the statement of changes in net assets. That is December. Sorry, we are doing a question of April. April 2025, question 4C. Question 4C. April 2025, question 4C. Good. Let's prepare the statement of changes in net assets. Statement of changes in net assets. So one major source I've told you already, one major source of revenue is contributions, and there are several. You can come and see your revenue or income, whatever you want to call it, contributions. Let me go to the question. I think there was employer and employees. Let me go to the question. The first one was employer, and I can see the amount is 36 for 80. Put it. First one was employer. The amount is 36 for 80. 36 for 80. Put it. The second one was from employees. And I can see from the trial balance, the amount is 18 to 40. 18 to 40, put it. Then you remember somewhere we read what we were calling voluntary contribution. Let me take you back to the trial balance. Where was the amount of the voluntary contribution? Yeah, good. I can see there. Members voluntary contribution 4560. Put it. 4560. And call this voluntary. 4560. Good. We move on. We are still looking for revenues. Normally, listen, normally for you to identify revenues, you can still go direct the trial balance on the credit column. Revenues are always found on the credit column. You don't find revenues on the debit column. Good. So we can even go direct to the credit columns and identify what they are giving us. If I look at this trial balance on the credit column, the next item is 3150. What is it about? Transfers in from other schemes. Put it. Transfers in from other schemes. Put it. Transfers in from other schemes. And the amount is given as 3150. 3150. Good. Let me look for another revenue or income. I'm still going on the credit column. After that, I can see the next one is 47. What is it about? Investment income. Put it. Good. We have investment income. Investment income. I've forgotten the amount. Let me go back. 47,400. Good. Let's go back to the question. We are still looking for incomes and revenues. From this trial balance, I'm going down the income at the column, the credit. Next one is 45. We have already dealt with it. That's members' voluntary contribution. Good. And paid benefits, that's a liability. That's one you know. Next, accumulated fund, that's capital. Next is accrued income. No, not accrued income, accrued expenses, sorry. That's a liability. So we are through with the credit column of the trial balance as far as revenues are concerned. So we are through with that. So we can now get the totals so that we minus the expenditures. Let's get the total so that we minus the expenditure. let's get the totals. I'm adding 36,480 plus 18,240 plus 45,60 plus 31,50 plus 47,400. If you are getting like mine, I'm getting 109,830, sorry, 109,830. Good. So we come and say a less expenditure. So obviously expenditure is found on the debit column of the trial balance. So I can still go back to the trial balance and pick the items on the debit column, of the trial balance. Let me project the trial balance. We can start on the debit column and pick the first one. I can see the first one is 1860. That's individual transfers out to other schemes. Put it. Individual transfers. You can just call them transfers out to other schemes. Transfers out to other schemes. Other schemes. Transfers out to other schemes. Let me put the amount on the inner column, 1860. 1860. Good. We go to the next one. After transfers to other schemes, I'm still picking the items on the debit column. The next one is property, plant and equipment. That's an asset. Government security. That's an investment. Next one is pension. That's okay. That's a pay expenditure. Put it. Pension. That's an expenditure. And we paid 76.40. 26.40. After that, I can see next one is equity investment. That's an asset. Both quoted and unquoted. Those are assets. Next one I can see on the column of the debit is 28.40. That's admin expenses. Put it. 28.40 admin expenses. Admin expenses. 28.40. Good. After that, we go to the next one. If I may pick the next one. After that, we have cash and demand deposit. That's an asset. Then we have change in market value of investment. We have agreed that's a loss. Put it. Change in market value. Change in market value of investment. Change in market value of investments. And the amount of the loss is 22,640. 22,640. Good. Put it to 640 as the change in market value of investments. Then I go on. We are still picking the expenditure, sorry. We are still picking the expenditures. From this trial balance, on the debit column, I can see lump sum benefits paid. That's already an expenditure. Put it. Lump sum benefits paid. No, lump sum retirement benefits. Just call them retirement benefits. Just call them retirement benefits. And we paid 48.20. 48.20. The last one I can see is contributions due in 30 days. That one I told you, that's an asset. There are some members who have not paid us, so we are demanding from them. That's an asset. Good. So I think I'm through with the expenditures or outflows. So let me add the totals. Let's add the totals so that we get the expenditures. 1860 plus 7640 plus 2840 plus 22,640 plus 48.20. I don't know whether you are getting like mine. I'm getting a total of 39,800. 39,800. We minus. Good. Let me get the net. Our revenues were 109 are good. We have a surplus of how much? So I minus from 109, 830. I'm getting a net of 70, 030. And being a positive, we call it surplus. Being a positive, call it surplus. Good. Let's now prepare the statement of net assets. That's a normal balance sheet. That's a normal balance sheet. Now, let's prepare a statement of net assets. Statement of net assets. The good thing is that this question did not have, listen, this question did not have an additional information to adjust some of the figures. You pick it direct, pick it direct, pick it direct. There were no adjustments like some questions give you some adjustments. No, this one did not have any adjustments. This one did not have any adjustments. Let's prepare the statement of net assets. We can start with non-current assets. Can start with non-current assets. I remember in the balance, in the trial balance, we were given a list. We were given a list of net assets. Let's go and pick them. Again, we can go to direct column of the debit. That's where we can pick the good. We were given several of them. I can copy all of them. No. But we can start with the property plant. I think that was the first one in the balance sheet. So let me call it PPE, property plant and equipment. I can see the amount is 132,320. So call it property plant and equipment. 132,320. 132,320. Good. That's one of the assets. Next one, I think after that, we're given another one. Government securities, copy it. Government securities, copy it. And I can see the amount of the government security is 263,645. 263,645. Put it. 263,605. That's the second asset. Finish. We go to the next one. We are still trying to identify the assets. After that, we now go to, I'm still on the debit column. I can see pension. That one we saw it's an expenditure. Next one, 87, that's an investment. Equity investment, both quoted and unquoted. Let's put it. It's an non-current asset. Put it. Equity investment. Equity investments. Quoted. The amount is 87,835. Then we have unquoted. The amount is 19,990. 19,990. 19,990. So finish. We are still looking for the assets. We are still looking for the assets now. After that, we go to the next one. I'm still on the debit column of the trial balance. The next one is 28. That's admin expenses. We have already used it. Cash and demand deposit, that's a current asset. Change in, oh good. It looks like the others are non-current current assets. Let's finish with the fixed assets. Then we now come and quote the current assets now. Come and quote the current assets. One of them was cash. The amount of the cash was given to us as how much? 28 what? 23, sorry. 23 or 60. 23 for 60. 23,460. Then I think there was a last one. Let me pick it from the balance sheet, from the trial balance. After cash and demand deposit, we had change in the market value. That was a loss. Retirement benefits paid. That's a benefit we paid. That's an outflow. Then the last one was contributions due. Put it is a current assets. I told you some members have not paid us. We are demanding from them some amount. That's like a data. And the amount of contribution was 49.40. 49.40. Good. So I think now we are through with the assets. We can get their totals. We are through with the assets. Let me get the total of the assets so that we now go to what you would call so let me add 132,320 plus 263,605 plus 87,835 plus 19,990 plus 23,460 plus 49.40. If I'm correct, I'm hoping I'm correct, I'm getting total assets to be 532,150. 532,150. Then we come and say here, accumulated fund and liabilities. Accumulated fund and liabilities. That's what in a balance sheet you would call equity and liabilities or capital and liabilities. Okay? But now they don't have capital, they call it accumulated fund. So we start with the amount of the accumulated fund which we were given in the trial balance. And the amount, if I may project the trial balance, the amount up there was what? How much? The accumulated fund. Oh, good. Somewhere in the middle. 461,560. Put it. 461. That is 461,560. Good. 461,560. Then from there we add the surplus that we made from the P&L, which is called the statement of net changes in net assets, and we had a surplus of how much? 70,030. We'll bring it. We made a surplus of 70,030. This comes to be 095. I am adding 1. That is 35. If I'm correct, I'm getting 531. 590. Then we go to liabilities. Listen, from this question, I never read anywhere where we had a long-term liability. No. I never read anywhere we had a long-term liability. No. So we go to current liabilities. There were some unpaid benefits and accrued expenses somewhere in the trial balance. Let's just pick them. They are always on the credit column of the trial balance. That's how you can know. Liabilities are always on the credit column. And the first one was where was it? Good. Unpaid benefits, 320. Put it. Unpaid benefits, 320. Unpaid benefits, 320. The other one is just next to that one. We have accrued expenses, 240. Put it. Accrued expenses, 240. Good. I can't see any other liability. It looks like we are through with the balance sheet. Let me add and see whether it's agreeing. That is coming to 531,590. 531, 590 plus 320 plus 240. That is coming to 532, 150. Good. Let me see whether it's agreeing. Yes, good. It has balanced. Finish. Look at the second one very fast now. Now you are conversant. You can see you can get good marks out of this kind of questions. They are not questions that come they came very late, or they have not come of late. You can see we are doing a question of April 2025. To finish, I want us to do another one just to apply. There are some questions I told you with some additional information, some adjustments of prepayment, accruals, blah, blah, blah. Those are just normal adjustments. Finish, I want us to project another one where we shall do it very fast now. Finish, if you are still copying, we do one more very fast now. Are you through? So you say yes, that I know whether to project the second one. In copying. If you are through, you say yes. Good. Thank you. So let's move on. Now I think majority of the people are through. Nekesa has said yes. So we can proceed now. Let me project the second one. There it is. And that second one is a question that came in April 2024. April 2024. It was question number 4B. April 2024. Question number 4B. This one we shall do it a bit faster now, just to practice what we have already said. April 2024. Question 4B. April 2024, question 4B. I want to read it. Says, I'm reading it. Mazuri Benefit Scheme is a registered retirement scheme. The trustees of the scheme extracted the following trial balance as at 30th of September 23. In that trial balance, you have interest receivable. You have payable to members. You can see it on the credit column. That's a liability. Then you have, of course, interest receivable is an asset. You have not received. You are supposed to have earned it, but you have not received it. That's an asset. Then you have receivable from members. That's another receivable. Those are like contributions due from members. Then you have current account deposit. That's an asset. Then you have fixed deposit. That's an asset. You have accumulated fund, that's of course a capital. You have employer's contribution, that's one we have been given on the credit column, 630.6. Then you have offshore investment, that's an asset. Property, plant and equipment, that's an asset. Next one is government securities, that's an asset. Then you have investment in quoted shares and unquoted, both of them are there. Then you have provision for exchange losses. Provision for exchange losses. Of course, I know you know this. Listen, let me just mention it. As a fund, you made a provision for exchange losses. Exchange losses. And you can see it on the credit column. Now, you know what we call exchange losses. These are losses that occurred because of the translation. Listen, exchange losses are what you also call exchange differences. When you do a transaction on a foreign currency transaction, when you transact on a foreign currency, as a company, you may end up gaining or you may end up losing. So you make a provision. So because of the fluctuations in the exchange rate. So these guys made a provision because they must have transacted on a foreign currency transaction. And what they did, listen, I can see from here, I can now remember, one of their investments, I think, was offshore. Let me see. Yes, I think I read somewhere that, where was it? There was a foreign transaction somewhere. Good. This offshore investment, which means they must have invested in a foreign country, in shares of a foreign country. So they obviously must have translated their currency. To buy the investment, they must have transacted on foreign currency. That automatically will either make them gain or lose. So they made a provision. I'll talk about how to treat it in a short while. Then we have interest on investment, that's an income. Then you have members' contribution, that's an revenue. You have management expenses, that's an expenses. With the withdrawal from the scheme, that's like benefits paid. Pension and commutation, those are benefits paid, pensions paid. Additional information. Number one, interest on investment amounting to 24.5 million was accrued as at 30th of September 2024. Remember, we have investments, so we are told interest on investment. You can remember there was somewhere we had interest here in the trial balance. Interest on investment, we received only 640. But the additional information tells us interest on investments amounting to 24.5 million was accruing, meaning we have not yet received it. Don't forget, this is an income. Don't confuse accrued to mean liabilities. The term accrued does not always stand for liabilities. It depends on whether you are dealing with an income or an expense. So here we are dealing with income on investment being accruing. That's an asset. Good. Number two, expenses or management expenses of 450,000 was prepaid as at that date. Then you are required, one, prepare a statement of changes in net assets. Of course, you can see 6 good marks. But two, statement of net assets, another 6 marks. These are questions you could get easily 12 marks for free. So let's do the question now. There are only 2 adjustments. From this question, there are only 2 adjustments. One on investment income and the other one on management expenses. Otherwise, the rest remain the same as they are given to us. So we just pick them and put them in. Let's do that very fast now, just as we close the revision on that question. This is a question of April 2024. That was question number 4B. April 2024, question 4B. So let's prepare that statement of changes in net assets very fast now. Statement of changes. In net assets. We start with the revenues. The most obvious one I told you are contributions, either from members, employees, or voluntary. Let's see what they have. I'm going back to the trial balance. I told you to identify the revenues. You don't need to. You just go to the trial balance on the credit column. That's where you can get. So the first item on the credit column is interest. No. Payable to members. That's a liability. Next one is accumulated fund. That's a capital. Next one is employer's contribution. Put it 630.6. 630.6. Put it. This is employer. 630.6. Good. Let's pick them. I think I saw another contribution somewhere. Let me go through the trial balance. I think I saw another contribution. Where is the other one? 160, that's a Provision, I will explain about it. Good. The next one is 640, 640, sorry. 640, those are members' contribution. This time there was no voluntary. So put the members' contribution, 640. Put the members' contribution. This is members, 640. Good. So let's go to the trial balance and pick other revenues. We are looking for revenue or incomes. We have only picked one in the name of contributions. Good. If I go by the trial balance again, I'm still looking for items on the credit column. The first one I told you was a liability. The other one was accumulated fund. 630 was employer's contribution. Provision for loss. That one, of course, we shall deduct it from the asset. I'll explain that. 640 was wait. Am I picking the right one? Am I picking the right one? Am I picking the right one? I don't think I'm picking the right one and nobody's saying. 640 was what? Was it members' contribution or my interest? Where? 640 was the interest. Look at those two now. Sorry for that. I picked the next one instead of the first one. Sorry. Yes. Interest is the one which is 640. 250.5 is the members' contribution. Please change. Members' contribution is 250.5. Please change. 250.5. Then we have investment income now. Interest on investment. Interest on investments. That was 640. Listen, and I think it had an additional information. It had an additional information. Let us look. Interest on investment. If you look at note number 1, you look at that note number 1, they are saying interest on investment amounting to 24.5 million was accruing. So we earned. We have already earned it. It's only that we have not received it. Good. Come and put it as 640 point what? So 640 point what? I've forgotten again. From the trial balance. Oh, just plain 640. Good. 640 plus what? Plus 45 point what? Or 24.5. 24.5. Good. So when I add those two, looks like I'm getting 664.5. 664.5. Is there any other income? No. We are through with the items on the credit column. Therefore, it tells me I'm through with the incomes. Let me add those incomes. So that is 630.5.6, sorry, plus 250.5 plus 664.5. If I'm correct, just a minute. Wow. I've indicated mine on again. That is 250.2, not 0.5. Another mistake again. Listen. 250 point. It is 250.2, not 0.5. I had put 0.5, but it's 0.2. Make that correction. I hope you will not make it in your exams. 250.2, not 0.5. Good. Let me now add. So I take 630.6, be confirming my figures from the question. 250.2 plus 664.5. If I'm correct, I'm getting 1545.3. That's our revenue. Now we less expenditure. We go to the trial balance on the debit column. We go to the trial balance on the debit column now. Go to the trial balance on the debit column. The first one is interest receivable. That's a revenue. That's an asset. Sorry. Interest receivable is an asset. Next one is receivable from members. That's another asset. Receivable from members. That's like what we were calling contributions due. Current accounts deposit. That's a current asset. Fixed deposit. That's our normal current assets. When you put money for 2 months, 3 months, and so on. That's what we refer to as a fixed deposit. Then you have accumulated fund. Then you have offshore investments. Then you have property. Those are all long-term investments. Good. All these are long-term investments. Good. Let me copy them as they are. One of them is offshore investment. We can even start with property. Wait. I'm thinking like we are preparing. I'm thinking like we are preparing a balance sheet. We are preparing the income statement. Sorry. We are still preparing the statement of changes. Sorry. I was rushing to prepare balance sheet, but that is not the right. So from the up, let me go through again. Sorry. We are looking for expenditure. Interest receivable, that's an asset. Members' contributions due, that's an asset. Fixed deposit, that's an asset. Sorry. Fixed deposit, that's an asset. Offshore, that's an asset. Property, that's an asset. Investment in quoted shares, that's an asset. That's an asset. So it looks like the first one as an expenditure is management expenses, 7 million. Let's look at that. Management expenses, 7 million. But don't forget, it was prepaid by for 50,000. These figures, don't forget, listen, these figures in the trial balance are in millions. So that is like 7 million, but it was prepaid according to note number 2. The management expenses were prepaid by for 50. Good. Let's quote that one first. This is management expenses. I take 7 million. It was prepaid by 250 or 450. We confirm. 450. For 50,000 is like 0.45. Good. Remember, it was prepaid. You minus. It was prepaid. You minus. If it was accruing, you will add. When an expense is accrued, you add. So 7 minus 0.45, I'm getting 6.55. I'm putting it on the inner column. I'm putting it on the inner column now. Listen. Then we come to the next one. According to this trial balance, 15 is what? Is a withdrawal. Put it. That's a withdrawal from the scheme. Withdrawal. And the amount is 15. That one did not have an adjustment. Next one, you look at the next one is pension and commutation. That's an expenditure. Put it. Let me just call it pension. The amount is 209. Good. So I'm through with the expenditures. So let me add that. Let me add the expenses. So this is 6.55 plus 15 plus 209. Looks like I'm getting to 30.55. If I'm wrong, you confirm, please. So do we have a surplus? Yes. Let me subtract from 1545.3. If I'm correct, I'm remaining with a surplus of 1314.75. That is surplus. Good. Let's do the balance sheet now very fast. We do the balance sheet very fast now. What we are calling statement of net assets. Statement of net assets. We can start with what we call non-current assets. There were several. Let me go to the trial balance and pick those assets now. Let's go to the trial balance and pick those assets now. From this trial balance, I think the examiner had listed them at the same place. You can see that. You can see that. The first one is what they are calling offshore investment, 1,200. I want you to listen to this now. But this offshore investment, listen, we anticipated to make a loss and we made a provision. Listen carefully. On this investment, which we are calling offshore investment, we anticipated to make a loss and we made a provision for exchange losses. Listen, you all know from your accounting knowledge, anytime you make a provision for something, listen, every time you make a provision for something, that provision should be deducted from the respective asset. For example, you know, when you make a provision for bad debts, you normally deduct that provision for bad debts from debtors. When you provide provision for depreciation, you deduct the accumulated depreciation from the asset book cost. So all provisions, it does not matter which provision. Any provision by the end of the year normally should be deducted from the respective asset. That's the point you should remember. So these guys had an offshore investment which they had already provided for an anticipated loss, which they are calling exchange loss of 160. Are we there? So we are saying anytime you have a provision for whatever, provision for bad debts, provision for depreciation, provision for exchange loss, all provisions should normally be deducted from their respective assets. That is an important point. So you can come and say here offshore investments, offshore investments. How much was the amount in the trial balance? You can see it was 1,200. I minus the provision against it, which is 160. So I've taken 1,200. If you can think you will forget, you can label this 160 provision or exchange loss. If you think you will forget that 160, what it is for, we are deducting a provision from the respective asset, from the respective asset. Good. So we are remaining with a net asset of how much? 1,200. We subtract the provision against that 160. I'm remaining with net asset amounting to 1,040. Good. The rest of the assets, I think they had no adjustments. We just continue and pick them. Let's pick all the others. The next one is property, plant and equipment. I can see the amount is 800. The next one is government securities. I'm just picking them. Government securities. I'm just picking them. The amount is 590. The other one is investment in quoted and unquoted. Investments. Unquoted. The amount of the investment in unquoted shares is 2,500. Next one is for the quoted ones. Investment which are quoted is 3,000. I hope I have not left out any. I hope I have not left out any. Good. Those are, according to us, the fixed assets. Finish. I want to go to the current assets now. This question had grouped all the assets in terms of fixed assets together. But the key important point is how to treat the provision. That was maybe the only small tricky item in this question. You had to remember that any provision for something should always be deducted from the respective asset. If it's provision for bad debts, we normally deduct it from debtors in the balance sheet. Provision for depreciation, we normally minus it from the cost, so on, and any other provision. Good. I think we can now go to current assets now. From the list or from the trial balance, I think we can pick from the trial balance. From the trial balance, I think the first one on top there, if you look at the trial balance on top there, the first one was interest receivable. I told you we have already earned but not yet received. Put it. That's interest receivable. It's an asset. Interest receivable. 80. Good. Next one, I'm going down the trial balance. After interest receivable, I can see the next one is receivable from members. That's another asset. Put it. Again, they have put down correctly. They have put the current assets like almost all of them in the same place now. Again, those three again, I just picked them as they are given to us. Are you seeing them? Those three, I picked them. That is the receivable. Receivable from members, put it. Receivable from members. The amount is what? 635.6. 635.6. Next one is current account deposit. Put it. Current account deposit. And the amount is 32.2. Next one is fixed deposit. Fixed deposit, I can see it's 260. So according to the trial balance, I don't think there is any other from the trial balance unless from the additional. From the trial balance, I can't see any other asset. 1200 was all assets. 800 was an asset, fixed asset. All those are other assets. Then you go to the additional information. Now listen. In the additional information, you are told interest on investment amounting to 24.5 was accrued. So that's what you can call interest income accrued. That's an asset. Let's put it. We have interest income that was accruing according to additional information number 1, 24.5. Put it. Interest income accrued. I told you the word accrued does not mean liabilities. It depends whether it's an asset or liability, whether it's an expense or income. We are dealing with an asset, an income, sorry. That is 24.5. 24.5. Then I think number 2 was prepaid expenses, management expenses prepaid. We have already mentioned it. That's already an asset. Management expenses prepaid, according to note 2, it was 450,000. Good. So we can put it as 0.45 because our balance sheet is still in millions. Good. I think I'm through with the assets now, unless I've forgotten out something. Because from the trial balance, I've picked all of them. From the additional, those 2 assets. Now I can get the total assets now. Let me add the assets. Let me add all those assets now. I take that 1040 plus 800 plus 590 plus 2,500 plus 3,000 plus 80 plus 635.6 plus 32.2 plus 260 plus 24.5 plus 0.45. If I'm correct, I hope I'm right. If I'm correct, I'm getting total assets as 8962.75. If I'm correct, I'm hoping I'm right. I'm hoping I'm right. That's what I'm getting. Yes, somebody says yes. Good. Finish, we go to the next one. We now go to equity and liabilities, but we don't call it equity. I told you, we call it accumulated fund and liabilities now. We can start with the accumulated fund. Let's go and pick the amount of the accumulated fund. How much was the capital by the beginning of the year? And according to this trial balance, this company had an accumulated fund of how much? Where was it? Good, 76. Hope I'm picking the right one. Yeah, 76.40. Pick it. 76.40. Then we said you add the surplus and the amount of the surplus that we calculated was 1314.75. 1314.75. 1314.75. If I add that is 0.75, that is 4598. Hope I'm right there. Good. Then we pick the liabilities. I don't remember reading any long-term liability. No. The only liability on the credit column of the trial balance was the first item in the trial balance. Interest, no. Members, payable to members. Good. That was the only liability. I can't see any accrued liabilities like in the other question, accrued expenses, nothing. So it looks like we have only current liability called members, payable to members. We have only one liability. Let me call it current liability. And that is payable to members. And the amount is 8. So let me see whether the balance sheet, I can call it 8.0. Let's see whether the balance sheet is agreeing 0.75, 2, 6, 9, 8. Yeah, good. It's agreeing with the upper total. Good. So we are through with that. Now you can see these are good questions. One can get good marks. So finish. I mentioned 1 or 2 points. Finish. Okay, it's not that we have covered everything in the topic. There are some theory things we have not discussed, but remember we talked about them in the normal class. But we have done or revision, we have revised the topic of pensions or accounting for pensions. Good. Now, before we stop, listen, before we stop, some of you, listen, some of you are watching me, listen, some of you are watching me through YouTube. Please, if you are watching me through YouTube and you have not subscribed to my YouTube channel, please go and subscribe to my YouTube channel. Click that subscription button and subscribe so that you may be notified whenever we post new videos into the YouTube. So if you have not subscribed, click that subscription button. And you may also click the notification bell so that every time we post new videos into the YouTube, you may be notified. Okay? I hope today you have enjoyed the class or you have at least learned something. You can also click the like button. You can also click the like button. Of course, the name of the channel is called our YouTube channel. That is the name of the YouTube channel is called CPA Joseph Njuguna. That's the name of the YouTube channel, CPA Joseph Njuguna. You can go and subscribe. If you're watching me through YouTube, you have not subscribed, go to that subscription button, click that subscribe button. Good. Now, also tell your friends that we are offering online classes for the following subjects. One is for advanced financial reporting of the advanced level. Tell them we are also offering online classes for financial reporting of the intermediate level. Tell them we are also offering online classes for financial management of the intermediate level. And finally, financial accounting of the foundation level, and also the one of ATD1 and ATD2. Tell your friends those are 4 subjects we are offering online classes for. They can join us, okay? And they can join us. They can call me on this number, 0722 658875, 0722 658875. If you need the country code, then it will be 54254722 658875. Click that subscription button if you have not subscribed. If you are watching me through the YouTube, say it. I hope you have learned something today. So please click that like button. Click that button. Then, because we have said, tell your friends. And if some of you are watching this and you want to join our online classes, then you can still call me on that number. You can call me on that number. Good. Maybe for today we can stop there. Pick it up from there next time, where we do something else. Unless there is a question, any comment. I hope you have managed to understand today. Somebody say yes. Have you understood something today? Have you understood something, at least for that topic? I have said it's a topic one can get good marks. Have you understood something? Somebody give a comment. Yes. Hope you have understood something. Good. Yes. Joshua says a lot. Thank you, Joshua. Joshua says a lot. That means he has learned a lot. Thank you. Fine. So if there's any other comment before I close the class, I hope you have benefited. You have learned that this is our topic. Good night. Thank you. Milton says yes. Good night. Okay, bye for now. Let me close the class. Bye for now.